can. We've got a lot to get through today, obviously. So I think I'll just kind of try and keep us moving. Probably the area that we're going to have most discussions around is revenue. So I'll time box that discussion wherever we get to. We'll take a break, then move on through the remainder of the agenda. And if we have time to come back to revenue at the end, we will do, I think. If everyone's okay with that, then I think let's move straight into section 13 inventories, and that's to you, Paul.
Thanks, Ian. The first question we have is around the scope to inventories. So we're proposing 2 amendments. First is expanding definition to include assets that are held for onward distribution to service recipients, as well as those that are for sale or use. And then we're adding a list of exclusions that basically reflect the those cases where entities don't have to, or in our proposals for revenue, entities don't have to recognize or have chosen not to recognize donated goods as inventory, so they're going to recognize them at a later point. So just checking whether the TAG members agree with the proposed amendments to the scope. Excuse me.
Okay, any disagreement with staff's proposals? Freddie.
Sorry, I couldn't find the hand. So for those donated inventories, I was just thinking, I'm not sure whether I will get to it in measurement part, but not to recognize them at all versus recognize them at cost should not be that different in terms of the outcome and effort. So I was just wondering whether recognition at cost would not be relatively easy and give the value to the users, as opposed to recognizing them only when they are distributed forward.
Oh,
We consulted in the consultation paper about the exceptions to revenue. So recognizing donated goods for sale when they were only when they were sold, and recognizing revenue for inventories that were for use or for distribution only when that took place. And that was strongly supported in the consultation paper. We'd agreed that to go ahead with that in the revenue section. So unless we're changing the revenue section, then I think we would need to include those exceptions in inventory, because people will be receiving the inventory and not recognizing anything until they either use or distribute. I think that there was some concern amongst stakeholders that there would be items that were received and never used, particularly things that were sort of donated in terms of food or medical supplies that might be very close to expiry date and may never be used. So actually trying to identify a value for those and take into account the likelihood of use was seen as potentially quite tricky. So I think that's why we were proposing to allow recognition of revenue only when the items were used or distributed. And if we do that, then obviously we need to have an exclusion in the inventory section so that we don't require people to recognize the inventory for that.
Okay, I think when we get to the exposure draft, what I would recommend is to then see what this comment or feedback coming from preparers versus users, because I think they may have different views on might not, but something that works for preparers, users may have a different angle on that. Not necessarily in this case, but okay, let's see what exposure draft will come through.
Thanks for that, Freddie. So I'd suggest we just have another look at basis to conclusions on that, and also the SMC. And I think it also underlines why we're proposing to bring in inventory alongside revenue as well in ED2.
Yeah.
Okay. Welcome to those that have joined, Easton and Anthony. Okay. So Paul, move us on.
Thanks, Ian. Next couple of questions relate to reliable measurement. So question 2 was, do the TAG members support the approach to reliable measurement that we're proposing? That if you can't, effectively providing guidance that if you can't reliably measure inventory, then you can't recognize any the items, but you have to make disclosures around that. And assuming we do include that guidance here, particularly thinking about the cases where entities are, or NPOs are responding in the immediate aftermath of an emergency, so they're potentially receiving items and distributing them almost immediately, have the ability to actually keep accurate records at that point, just because of the situation on the ground. So providing guidance that in those cases measurement isn't reliable, then you don't recognize anything and instead make disclosures. So that's the proposal for inventory. We think that if we do that, we should probably have similar guidance in the revenue section, because for items that are used or distributed, if you're not recognizing inventory, NPOs may be choosing to take advantage of the exception to not recognize revenue immediately, but to recognize revenue only on use or transfer to the service recipients. So you would hit a similar situation there. So we think we probably should replicate the guidance in section 23 as well.
Aaron.
I should add, I had a pre-meet with so I want to apologise, I don't have much voice at the minute, so bear with me. But I had a pre-meet with both of the Jeffs earlier on this week, and I think they raised a concern about too much emphasis on unreliable measurement. I think their concern was that if there was too much emphasis on that might create the expectation that things wouldn't have to be measured rather than the other way round. So just to let you know that they have raised that issue with us.
Okay, thanks, Karen. Catherine, to you.
Yeah, I had a similar concern. I think in my experience, the exception to say that you can't reliably measure something is pretty rare to be able to make that argument. So I guess one, I'm concerned about providing sort of this loophole, and to what extent could that be sort of expanded if we have it here and start, by analogy, applying it to other things. Or on the flip side, is this argument going to be hard to buy? Like, I even struggle. I understand it's challenging in the sort of emergency scenario where inventories are coming in quick and going out quick. But, when I used to have an auditor hat on, I don't know if I'd buy that as saying you can't reliably measure. It's challenging. So if that's sort of what we're going to try to hang our hat on to give exceptions to this recognition, I think we might need to take a step back and think about it a bit more. I know I think I'm on kind of the flip side of Freddie, because I'm a little bit not concerned, but just not sure providing relief on the recognition of inventory. But then sort of when we get to the revenue side, you still have to recognize that the revenue and the expense on disbursement. Are we really providing that much relief? Because yes, you don't have to recognize the revenue, but then you do have to recognize that revenue and expense. So I'm just concerned that this exception isn't enough for those cases where we think that people can't do it, and so we're creating too much of an obligation around some of those, the measurement of some of those things.
Paul, back to you on that. I mean, it does feel, listening to the comments, that we're almost in the sort of, and I know people don't like the use of robust presumption, but we're almost, that's almost the sense of where we're going. Paul?
Yeah, I mean, they included this guidance because it was raised specifically in the comments to inventory in the consultation paper. I mean, if you can't reliably measure something, then you don't meet the recognition criteria for an asset. So I think that's, it's always going to be there in the conceptual basis anyhow. The question, I think, is whether we need to include specific guidance or whether specific guidance is helpful for MPOs or not. And, if so, do we need to flag up that this will be should be a very rare occurrence?
Well, I think that was where I was sort of, going with the rebuttable presumption idea that sets the expectation that you should, and it's very much the exception. And I suspect that, Karen, is that the sense of the conversation with the two Jeffs? You're on mute.
I'm mute and unmuted. I think that was very much the sense of what they were saying. I think their expectation, they said even in the disaster one, is that MPOs that are set up to do disaster type things should have the systems and processes to record this kind of thing. So I think that was why they were a bit worried about undue emphasis on that, because their expectation is that the majority would be able to do this.
Catherine, just before I go to Sam, is that sort of going in the right direction in terms of your concerns then?
Yeah, I think that would be helpful. I think we just need to be careful about not suggesting that this is something that in every scenario there's a disaster and you would always meet this requirement or not meet this requirement, I suppose.
Okay. So that sort of sets a high bar without saying absolutely will have to be done every time. Sam?
Yeah, I just wanted to bring in the perspective of more local responders. So yeah, the big emergency kind of organizations, you can imagine having the staff, the systems to do that. That's what they do. But very often the first responders are the local community organizations that don't have in any way that sort of thing. And I can really imagine scenarios where the accountants are go, hang on, stop delivering aid because we've got to catch up with our bits of paper. This is the sort of reaction I can imagine this getting. So I think it's really important to have those exceptions. You don't want accountants getting in the way of aid delivery. And you want it to be appropriate and proportionate to the type of organization. We're targeting this not at the massive, big international disaster responders. We're targeting this for the smaller MPOs that are running on the ground, and they want to have their credibility. They don't want to be suffering poor audit opinions for not having the accountants on the ground when they're responding to an emergency. So getting that sense of proportion.
Yeah, thanks, Sam, for those reminders. I think that's helpful. Freddie?
So on that, in our simplified proposals, the board is thinking actually to give an option to recognize at cost and or current replacement cost, because there is a question of recognition and then measurement, and the measurement is the heartbeat. The recognition and the evidence behind that should not be that hard, even though I absolutely appreciate that there are cases where it's hard when it's emergency situation. But I think that's where we are trying to find the balance, and maybe it's the really much more smaller entities we are thinking here about in Australia. But I think that's an alternative solution that our board is thinking.
And that's your tier 3, isn't it, Freddie?
That's right.
Yeah. So if we go with the rebuttable presumption idea on this one, explain, and I think Sam's points were useful in terms of making sure that those are drawn out in basis for conclusions, and then make sure that we construct the specific matter for comment in the right way. Does that then kind of reconcile the various different issues that we need to here? Okay, good. Thanks for those points. Paul, move us on then.
Thanks, Ian. So I think our next question does relate to measurement. So our proposals are that inventories that are required through a donation are measured at fair value, which is the initial approach. Inventories for held for distribution would then be measured at, using fair value as a proxy for cost, would be measured at cost, or either net, lower of either that cost or net realizable value, or just allowing for where net realizable value isn't particularly easy to identify, which may be some cases, allowing for an impairment for any loss of service potential. And this is based to some extent on the guidance in the UK accounting in, I think it's FRS 102 rather than Charities SORP, but I think that's where we're basing this guidance on. So we're just checking that members are happy with that approach to measuring inventory going forward. So it's either for donated inventory, it's either at going forward, it's at cost, adjusted where appropriate for that loss of service potential, or lower net replacement cost if that's lower.
Okay, thanks, Freddie, to you.
Yeah, thanks. I had to refresh myself, and it's actually maybe not making any practical difference, but I think in our inventory standard for not-for-profits, we actually have a CRC instead of fair value, and obviously SASB members will appreciate application of fair value in not-for-profit and public sector. So, and I think that was the reason years back when they decided to go CRC, which arguably is part of fair value, but to go specifically to RC. And then actually CRC is defined as a really entry price as opposed to anything else. So I don't know whether we should ask then constituents to see whether fair value, like pure fair value, would be then too hard, even as a concept in that space. But what practically, whether the practitioners are asking themselves whether they are recognizing inventory at fair value or CRC, whether it makes any difference, I actually don't know. Whether a question mark on that. Thanks.
Yeah, thanks, Freddie. The question of all of this around inventories, I think, is on the agenda for June, and SASB actually now we finalised the measurement standard, and we're going through looking at all the non-PP&E standards and how we might fit the new guidance in. Easton.
So I appreciate that section 12 hasn't been looked at, and I think that's on your to-do list of the IFRS for SME standard. But I think what has been proposed by the ISB in respect of that section is a hierarchy of inputs, and I think there's potentially some scope for you to keep it within working through those three levels to actually get to something that would be fair value but on a different basis. I would just worry some of the wording is, so for example in 3.11 of the paper, where there's no observable market, you'd refer to the cost to the donor. It sort of begs the question, if there's no observable market, would the fair value then just be 0? So it's just, maybe it's putting a sort of thoughts on hold around fair value till you explore what those three inputs would look like for not-for-profits, because you might actually get your answer rather than introducing a number of different exceptions, which probably add a bit more complication around the concepts and notion of fair value, which will come up in various sections that you're going to deal with or already have dealt with.
Thanks, Easton. Karen, do you want to just add any thoughts on process there? Because I think this is a process thing, isn't it, in terms of managing between the ED2 and ED3. And I think Easton's raised a very valid point there in terms of the the measurement hierarchy and IFRS 13.
Yeah, and it's a really good point, and it's a sort of a challenge that we face in having exposed in sections, if you like. That was one of the potential downsides of doing it this way, is that you are looking, we can only look at certain sections, and so there may be consequential changes that you would make when you look at other changes, and we're already seeing it in terms of section 6 that we've exposed. So the drafting does refer to section 12, but it doesn't do anything more than refer to it at the moment. And so I think we want to avoid going into it too far, particularly as section 12 is not one of our priority topics for this first set of impact. So I think we're making the cross-reference there. I think we do. I think it is worth thinking about the 3 level of inputs and whether there's anything that we could usefully clarify at this point. I think otherwise we will then look it up, pick it up when we look at ED3, and if there are some consequential amendments that we need to make as part of that, we will include those in ED3, just as we're proposing to do in ED2 in relation to section 6.
And I'm wondering on this one whether we could effectively put that placeholder in via the basis for conclusions. Bearing in mind what you said there, Karen, about where the expectation is that we're only really making editorial changes. So in a way, that might be the way to do it, rather than, if you like, hardwiring exceptions in at this stage. So, Paul, perhaps, the suggestion would be that if you can take that away and approach it on that basis, that's probably the best way, so that it's still maintaining, if you like, a principle-based approach, but it's also managing as well the sequencing issue.
Okay, yeah, I mean, I think the reason we'd put this, or I'd put this in, again, responding to comments to the consultation paper, is that I wasn't expecting there to be any changes such as references to cost to the donor going into section 12 at this point, because we're not looking at any of those sort of updates to section 12, given it's not a priority. So it will be in a second phase of IPSAS impact. So I think the question is, are we happy that we just deal with that in basis of conclusions and say, when you're looking at developing an estimate for where there's no observable market value, cost of the donor would be one thing that you look at in the basis for conclusions, with a note that would then be looked at in a later phase of INPAG, or do we want to put it into the actual guidance where potentially it's more likely to be read?
I wonder whether that's not one that we take if we're kind of content with the overall approach. I think, Paul, that's probably one for Secretariat to take away and just work out where they think it's best in terms of the balance.
Yeah, that's fine.
So that could be AG material is the other approach possibly.
Yeah.
Okay, and I think that's as much a process issue as anything. Okay, so move us on then.
The next one is we had a suggestion again in the consultation paper responses about including an additional cost formula. This would be first expired, first out. And the thoughts there were particularly for NPOs such as food banks or medical charities. They often will receive donated items that are close to their expiry date, and therefore the value of those items will be lower than if you were just purchasing items generally, which would have a much longer expiry date. NPOs who are doing that would need to have stock management systems to make sure they were issuing in line with expiry dates anyhow. So the view was that actually, because particularly if you've got an NPO that has a mix of donated items that will typically be close to expiry date and purchase items that will have a higher value because they've got a much longer expiry date, just using first in, first out or weighted cost may not accurately reflect the value of the inventory that was left. So we can see our arguments both ways for that. So we've drafted the text to include it so that TAG members can see what it would look like, but looking for views from members as to whether we should include this or not. It would be an NPO specific example, because if you're producing the goods yourself, then typically you'll be producing them all with a long expiry date, while you might be holding stock that's got that shorter expiry date. You would be dealing with that either through impairment or through your first in, first out methods.
Thanks, Paul. Elaine, you were quick off the mark.
Thank you, Ian. I agree that the additional cost formula actually provide more representative information, but at the same time, I do agree in the analysis in paragraph 3.15 that this may actually require sophisticated inventory management system. Because I'm also looking from the point that, yes, of course, it's good that we set high standard, but at the same time, I think we should also balance the cost and benefit for the requirement. And because of this, I'm more inclined not to actually include this cost formula. Also, particularly after I heard from Sam just now in relation to the first question, like who are we talking about, the NPOs, you know? So that's where I'm coming from. From the technical point, yes, but more from the operationality and the NPOs, and who are the NPOs that we are talking about. Thank you.
Thanks, Elaine. Karen.
If I can provide some input from the Jeffs on this, I think it's fair to say they didn't mind either way whether it was included, but they did raise the cost benefit question that Elaine has just mentioned, and they also raised the question about whether this really was an NPO specific need, because those organizations that are in groceries or pharmaceuticals, you know, have this as part of their day-to-day operations. I think they didn't know for sure, but I think they thought the average sort of weighted average cost methods were used by those kinds of organizations, and you know, while it might help NPOs, they think that there's probably sufficient there already, that nothing specific is necessary.
Thanks, Karen. Easton.
Yeah, I think I'll usefully go off the back of what Karen was saying about the comments she'd received. As when we looked at that, we had a concern that actually the method goes above what is in IFRS for SMEs and IAS for an issue that won't always be not-for-profit specific. So obviously there's a bit of sort of proceed with care in that respect. I also think just the explanation that was given by Paul was quite helpful, was they will require quite sophisticated systems of inventory if they're looking to implement this, which sort of begs the question as if they can identify goods and segregate them based on their expiry date, would they actually be needing to implement such a cost formula anyway? And then also, I think the current guidance does include scope for entities to use different cost formulas when they can be justified. So whether there is actually a need to specify a new one in respect of this particular type of business model, I think entities could get to that method you've specified already within the scope of the current paragraph.
Thanks, Easton. I think that sounds like a good summary. Actually, I'm not hearing support for inclusion of a separate method, and it may be, Paul, that we can include effectively, to allow people to get to that, as Easton suggested, without actually creating a departure. So I think, if we can leave you just to think that one through in terms of how that would work. Obviously, we need to flag that the point has been raised and how we've actually dealt with it. And again, that may be a basis for conclusions point as it was raised, and this is how we've dealt with it, which would underline that, we're not totally ruling it out, but as Easton suggested, we're getting to it through that hierarchy approach.
Yeah, thanks, Ian. Yeah, I think maybe moving sort of the discussion to the basis of conclusions would be helpful. It was raised, as I say, from the consultation paper responses from I think it was one of the NPOs that does have this type of issue, and clearly has the stock management systems that to enable them to do this. I think in terms of it, what's unusual for NPOs from the NPO makes it potentially NPO specific is, if you're purchasing things, you'll typically have a longer expiry date, whereas if you're an NPO, you may be both purchasing with items with the longer expiry date and then receiving donated items that have been denoted because they are close to expiry date and therefore have a lower value. So I think that was raised as the NPO specific, that mixture of receiving, purchased and donated items.
Yeah,
but happy to move that into the BCs.
If we go the proposed route, then I think we've acknowledged it, and we've also allowed, if they can make the argument, there is a route through to that. Sam, quick point on onions to move us on.
Yeah, very briefly, I think the idea that many NPOs might get there by themselves by applying there are other alternatives possible, I think might be asking a bit too much. I wondered if it could go into implementation guidance as something like that, mentioned in the basis of conclusions, but most people won't read the basis for conclusions. The implementation guidance gives preparers and auditors a more of a steer that you could apply this optionality in this way, potentially.
Paul, do you want to take that one away and just have a think about that?
Yeah, I'll talk to Karen. We'll have a look at location.
Okay, good. So move us on then, just the final point on impairments.
Yeah, final point on impairment is we've just made some consequential amendments to the separate section or separate part of section 27 that deals specifically with impairment of inventories, just to update the measurement there to reflect the changes to measurement in inventory section.
Okay, any comments on the proposed approach? Okay. Good, I think we're fine with that. So I think that then takes us through inventories. Just to pause and welcome Catherine to the call. So welcome, Catherine.
Thank you. Sorry, I had a bit of a problem logging in. Thank you for admitting me.
Okay. So if you get the chance, put your camera on and enjoy it and join the meeting. And with that, we will move then into revenue, Paul. And as I said, we've got a lot to get through on this one and some quite tricky issues. So I'll allow the discussion to go wherever we get to, and then we'll break it at 10 to the hour, because I want to make sure we get a break and then we move into the other issues, and we'll come back if we get time and finish up on the item we need to. So Paul, over to you.
Okay. Thanks, Ian. I was going to share some slides just to go through the questions, because we've had couple of focus groups this week, and so I think some of the questions we need to sort of think about perhaps in a different way, just to bring in the responses we had to the focus groups. The moment, could somebody let me share slides, Karen?
Paul, if you carry on, I'll try and sort that out in
Okay.
the background. If not, I'll share them.
That's fine. So the first issue was the distinction between part 1 and part 2. This was raised by a number of TAG members responding to the first draft of the revenue section, particularly around transactions that had subsidies effectively. So they weren't purely contracts with customers, weren't purely grants and donations, but there was a subsidy element in there. Secretariat is proposing that where you have those transactions, they should be split into 2 different elements, one for grants and donations, one for contracts with customers, each element being accounted for under the relevant part of section 23. There were different views amongst TAG members about this in the responses. Some supported this approach, others proposed that the guidance should be such that transactions fell either wholly in part 1 or wholly in part 2. So seeking members' views on the Secretariat recommendation.
Thanks, Paul. And I think, you know, there's a nexus of a number of issues. One is practical in terms of building off IFRS for SMEs. The other is actually where you put the boundary in terms of whether you use exchange and non-exchange. And I think all of those reasons underline why in its new revenue standard, it has been moved away from having one standard to having two standards to one standard, precisely because of that dividing line and people not knowing which area of guidance they should be in. So I think we're sort of kind of stuck with perhaps a non-ideal situation here, but you know, I think that's really what we're facing. So open to comments then in terms of views from TAG members. Yeah, Catherine. Sorry.
I don't disagree with this recommendation. I guess one thing I just wanted to raise to consider is often there can be sort of an intangible component that's exchanged, like the contributor might get, you know, have some sort of intangible benefit, whether it's reputation, something along those lines. So we might just want to address that in order to make sure, like, I wouldn't think that we would want that type of part of the transaction to have to be split out. So we might just want to think about whether we address that somewhere, even in the basis or application guidance on in what needs to be split out and what it shouldn't be.
Okay, thanks, Catherine. Paul, perhaps you can take that one away and just have a think about how we address that. Freddie.
When I was reading this, it does resemble the situation we have currently, where we have IFRS or local AASB 15, which includes also not-for-profit. So basically those donations or grants which would be sufficiently specific, and then we have another standard catching everything else. But there is an element that throws it back to 15 as soon as there are again some sufficiently specific obligations. So I think and I have a question then later in a paper on distinction between compliance, and because there is still a word distinct being used. So I would be probably in a camp if you have one place and step through, is it a commercial transaction and sufficiently specific? Is it a non-commercial transaction sufficiently specific? And then to deal with whatever is left, because we have been hearing feedback from not-for-profits that to jump between 2 sets of guidance that are relating to each other and many times actually similar or same is not helpful and confusing, to use that word.
Thanks, Freddie. I mean, that's exactly the feedback that IPSASB got, which caused us to move away and essentially move the boundary in terms of where the split sat in our guidance, so that effectively, although performance obligations are a subset of compliance obligations, actually we moved the boundary to, is there a compliance obligation or is there not, through the binding arrangement And that was really the reason, because people did say, look, this is really confusing. We don't understand which piece of guidance we should be in. But I think that's also the problem we've got here, which is actually, do we work around the existing chapter, which is obviously based on IFRS 15, rather than create something totally different.
Yeah, and I think it will come down to also how different then those 15 or performance obligation and concept of compliance obligation really is. And I know, and that's great that we are working together to remove the duplicity between the two sections, but I still feel like there are, when I was reading it, there is still a fair bit of, I'm struggling to draw the line. Just think, took me, well, if I'm struggling to draw the line between the two concepts, should this be in one place as opposed to two? But I don't think there's a perfect solution. I think it's maybe for the exposure draft, we want to talk about also alternative presentation drafting.
Mm-hmm. Yeah, I mean, there may also be something about which order you hit the models in as well. Where you go first in terms of thinking about it. Karen, I don't know whether you want to say anything on this at this stage.
There's a little bit of sort of keeping our powder dry, because we've been talking quite a lot about this over the last week, and particularly in the context of the focus groups that we've been running, which Paul alluded to as well. And really kind of rowing back in terms of kind of what do we expect to see, what do we want to the financial statements to appear like, what is the information that is going to be useful in that, and using that to try and challenge our thinking, to try and make things as simple as possible. So I think, as Ian said, we're going to come on to a conversation about this, particularly around, what is something that has a restriction? What types of arrangement have we got? When would revenue recognition occur in terms of some of these arrangements? So we want to have a more detailed discussion about that. I did think your comment was really useful about, is this a commercial or is this a non-commercial transaction? I think we need to look at language, because I think we kind of decided to move away from that exchange, non-exchange type way of describing things. But I think there is this point about, is this materially a contract with customer, or is this materially a revenue from grants and donations, so that we're only really getting into sort of the grey areas, probably in the minority of situations, and trying for, using the 80-20 rule, at least have 80% being really clear whether it's part one or part two. So I think there is perhaps a bit more that we need to do to try and make that bit clearer, that you're likely to be in one place or the other, and it's in more minor minority cases that you're going to be somewhere between the two.
Thanks, Karen. So signposting being important there, and that sounds like quite a good, that would help people to think in that way. So we'd need to think where that messaging went in, wouldn't we? And that does come back to positioning, etc. Tim.
Yeah, I wanted to ask, given that IPSAS 47 has only recently been published, and you've clearly done a lot of thinking about the challenges around this kind of marginal definitions. I mean, I'm trying to understand, why wouldn't we try and piggyback off IPSAS 47 more, given that overall our kind of basis was that's our second port of call after IFS for SMEs, and where it's more likely to be relevant to the non-profit sector. So I'm just trying to understand why we would try and develop a third way solution rather than try and follow IPSAS.
Can I come back on?
Yes, I was going to say, Karen, if you want to come
Yeah.
back.
So I don't think we are trying to find a third way here. I mean, we are really looking to IPSAS 47 to inform what we're saying about grants and donations. If you're referring to why have we got two sections as opposed to one, I think the view of the tag previously was that revenue is such a significant topic for non-profits that there was a risk that we wouldn't appear credible if we didn't appear to have guidance that was specifically about grants and donations, that's written for that topic, when that is the thing that causes NPOs such significant difficulty. And I think there was a feeling that there would be an expectation, there was an optical issue around this, but also for many NPOs, they will only have income revenue from grants and donations, and so want it to be as simplistic as possible. So that's the advice that we have been developing around to have it two separate ways. It is challenging because when you look at IPSAS 47 and you look at IFRS 15 and what's in IFRS for SMEs, the revenue recognition model is pretty much identical. So some of the terminology and the way in which you apply it is different, but the 5-step model for recognition is a common model that underpins both. And that's when you get into kind of our risk around duplication. So, although presentationally we're saying that grants and donations are different, actually, when you come to the nuts and bolts of it, the underpinning principles around recognition and measurement are exactly the same between the two. And I think that's the thing that we have been wrestling with to some extent. So and why we have the two chapters in the way in which we do.
I'm wondering, Karen, would it be just helpful at this stage just to show that diagram that I think is on Paul's slide 4, which is from the basis for conclusions in IPSAS 47, that just sort of underlines, the relationship between the various different concepts.
Paul, could you do it? Paul's got control of the slide deck, so whoops, too far. There we go.
That's the one. Yeah. So what we were trying to do here was because Karen's exactly right, that what we've done is to stretch the 5-step model in IFRS 15 because of the circumstances of the public sector, and to say that not every revenue generating transaction falls exactly into IFRS 15, and we needed that broader concept of the compliance obligation, which fits in then with the revision that we've made to our conceptual framework, which now actually brings it into line with the ISB's framework, actually. And so in terms of the way we've defined terms and so on, it was very deliberately done such that when we were defining a broader concept, that it also included that narrower concept. So compliance obligations do include performance obligations within them. I think obviously we did this based on feedback from where we originally had split based on whether you had a performance obligation or not. And constituents just said that's not helpful, which was why in the end we pulled it all together and spent about the last 2 years actually working through all the responses that we had. So if you like, just in a diagrammatic way, why we ended up where we did, and also how it's now consistent with not only IFRS 15 but also with the IPSASB framework and also the now the ISB framework. I think clearly the balance between the different types of transactions is going to be different for NPOs, but that's what we were struggling with anyway. Just if that helps. Freddie, did you want to come in?
Yeah, thanks. And I think that's when look, this is very helpful, and I will have a couple of more questions, but later. But going back to the kind of structuring, that's I was thinking whether a single section, because many things are same, including the 5-step model, and then within that section, which can be, you know, revenue and income from grants or something like that, and then within that section, a subsection that draws on that difference between, I will call it commercial, non-commercial, to highlight some differences or extension of those lines between deferral and non-deferral, if you want, would help, and also would remove that duplicity in drafting. And I think would be reflection what it really is, that IPSASB did not really fall too far from where 15 is. It's about the boundary of that obligation, as opposed to anything else. And predominantly that section will still be pretty much about revenue from grants, but many of those will be actually following a 5-step model, including the allocation of the, I will call it, transaction price against those obligations, whether performance or present obligations.
Thanks, Freddie. Karen, I think this is tactical as much as anything else, isn't it, in terms of how we approach ED2 and drafting and so on. Because I think you're right, Freddie, you know, in the end, actually, this just stretched the ideas in terms of, you know, and put the focus on binding arrangement. So Karen, just to you really, in terms of, you know, how we approach this.
Yeah, I think you're absolutely right. It is completely tactical in terms of, you know, approach. And I think we'll need to ask, we need to think about what questions we might want to ask about this that doesn't ask, do you want, you know, what sections do you want, but goes to the ease of using the sections and how that could be improved. So I think we can think about that. But I think we're also looking at, I think I might be jumping ahead here in terms of what Paul is going to cover, but where we think that there are parts that are less likely to be used in a grant and donation perspective, rather than repeating it so that it appears in part 1 and part 2. I think we intend to cross-reference a bit more that says if you've got something that really is more complicated, you know, there is guidance in part 2 and you should follow the same principles. So I think we're going to do a bit more of that for things that we think are going to be at the exceptional end of the spectrum, so that we can really hunker down in part 1 on the more common transactions around grants and revenue, so that it is there all in one place. But should hopefully shorten the drafting and make it a lot more specific. So I think that's what we are, you know, that's what we're thinking of doing by way of approach.
Aaron, sort of thinking on my feet here, is there something then in terms of the order of the material to help doing that, which is that you might have the sort of what's you might switch the ordering of the chapters.
So we can certainly have a look at that. We're certainly looking at what goes in the preamble. So we're certainly looking at bringing forward the 5-step model into the bit at the front that kind of covers the revenue recognition approach, because it applies to both parts and sets that out at the beginning and means that we don't have to duplicate it in both sections. But I think if we once we've drafted that, I think we can look at, depending on how much cross-reference there is, we can look at whether it makes sense to do it revenue from contracts with customers first or the other way around.
Thanks, Karen. And I think, you know, probably what we do need to reference is the fact that it might be possible in finalising in the way that IPSASB has done, actually to put this together into one section but actually, somehow ask that question. Because I'm mindful of practicality as well as at this stage.
Completely, absolutely. So we'll find a way of framing a question that goes to that issue, because the usability of it is critical, and I think that's probably where we'll focus in terms of the structure of the sections. Does that help drive usability, that practicality?
Yeah. Okay. It's not easy, this at all. So if we go with that kind of approach, that it will be 2 chapters, start to have a look at the ordering of that. We've got to get the narrative right along the lines of the point was raised about commercial and so on, albeit not defined. Now, Paul, I don't know if you saw my email, but I was thinking that, I think we might well have quite a big debate around the restrictions. So if you're okay, if we go to question 6 at this point in time, and then we will try and come back. But I'd just like to get through these questions if we can, and get TAG members' input on these.
Thanks, Ian. Yeah. So the next group of questions that we're looking at then is gifts in kind and services in kind. So we're proposing, based on the recommendations from the last TAG meeting, that we were going to require revenue recognition for services in kind that are critical to an MPO's mission, and permitted but not required for other services in kind. We had some additional guidance on fair value measurement, reliable measurement, which I think we can ignore because we've covered that already in the inventory discussions. And then we had some redrafting of the permitted exceptions. I think, again, feedback from the focus groups is we probably just need to look at tightening that drafting up a little bit as well.
Okay, thanks, Paul. So could I just take comments on question 6, and then we'll just deal with the other couple of questions after that. So any points TAG members want to raise on question 6? Yep. Bill, then Freddie.
Yes, I just wanted to say that I'm one of the chief opponents, had been one of the chief opponents to this in the past, because in Mexico, we do not recognize services in kind because of all the complications around it. But I've had recent discussions about those that are essential and critical to the mission and those that are not. And I'm still getting mixed responses. Among our board members, there are those that think that's a great idea to enhance comparability, and those that think that comparability is not that much of an issue, they think, between MPOs, because what 2 MPOs can actually be compared. So I'm less against it than I was before, but I still have my questions about its operability. But nevertheless, I wanted to withdraw, if you will, my comment about you should never record services in kind. I think there's a good argument made there. So I've gotten some sympathy for it, but it's not unanimous.
Okay, thanks, Bill. I think that's helpful, and probably in moving forward, it's probably quite helpful to put a proposal out there and make sure that we draw people's attention to it. So both explain that sort of thinking, as you said, but then say, but this is the way we've gone. What do you think? And to use that to solicit feedback. And I suspect it will never be unanimous. Whenever I've seen this debate.
Exactly.
Freddie, to you.
Thanks. Yeah, similarly, I think the definition and what does it mean critical to mission will be important, because it's complicated enough to value and get the prices for those services in kinds to the extent that are available, but also to determine which ones are critical. And I was wondering whether that's something which would be not already disclosed in some section of narrative reporting, whether it's inputs or some sort of management commentary. And then once the that dependency is disclosed one way or another, whether the revenue recognition and measurement is so crucial for the users. But I guess, because what you just said, Ian, maybe it's actually useful to propose that in exposure draft and get the feedback.
Okay, thanks, Freddie. Any other comments? Anthony?
It's just a question for Paul, and sorry if I missed it in the notes. Is there an assumption here that if it's critical that the entity should be able to measure it? Is that what it's?
I think that's the view, yeah. But I mean, obviously, we had the discussion under inventory about potentially using cost to the donor about as a proxy for fair value. And you can see that being actually useful or being more relevant for donations of services in kind, where the donor will know the cost of the services in kind, but there may not be a market for those services. So that may be an area where going for NPOs going to the well, we don't know what it would cost us in the market for this, but we do know what it's cost the donor to provide those services. So that's what we're going to use. Might be a way forward in terms of getting that services in kind information. Thinking particularly where there's sort of maybe professional services provided from a different country.
Okay.
Okay.
Yeah. The approach in New Zealand is if it's critical to you, you can choose to do it. But I don't mind this going out to get feedback on it.
Okay, thanks, Anthony. Sam?
Yeah, I just wanted to share, sort of came out in the focus group, but also just in other conversations I've had with people from different kind of cultures, like the idea of valuing, I don't know, say somebody who's caring and sitting with elderly people and having conversations with them, or, how do you try and put money to that? The very notion of even thinking about slapping a dollar sign on it is frankly offensive and distasteful. Like, it's so counter the whole culture of what the sector is doing and trying to do. And I think that's something we need to somehow create space for, that some things, you devalue something by having to put a market price on it. And we're in an area where we're social, we're care, we're whatever it is. And the artificialness of slapping a dollar sign against something that is intrinsically maybe not valued by the market. I just have real issues with requiring it, shall we say, rather than permitting it.
I mean, I think, Sam, every time I've heard the discussion of that, exactly that argument has been put forward. And I think it's a question of degree here. And I think that's what I'm hearing from other members. And so in a sense, actually, I think what we're proposing is being slightly harder on this, really, with a view to actually getting some debate going. So it's a tactical position rather than where we might end up exactly. But I think we need to put the proposition out there in order to hear, how loud the concerns are. I think, we can certainly reflect that nuance in terms of it's balanced. And I think you're right that we should actually reflect that there are differences of views, for example, in that direction. So it's not that we haven't seen this, but actually we're deliberately going out with a sort of firmer position on it, and then we'll see what we get back. That's okay. Catherine?
Yeah, I have similar concerns about requiring measurement of everything, and it sort of links back to what the proposed definition, I guess, of critical to the mission is right now, and whether that's going to capture too much. I'm specifically thinking of foundations that do a lot of fundraisings, runs, and things like that, and would rely on volunteers for those. And without those volunteers, their level of activity would be reduced because they wouldn't be able to run events of the same scale, and certainly the cost of having to pay people for those services would probably be prohibitive. So I guess I think maybe there's the potential to look back at what that definition of sort of critical to the mission is, and maybe we could narrow it in that way, or play around with that a little bit to maybe try to scope out some of these things that give us all, I think, a little bit of discomfort in terms of requirement to recognize. And the only other point I wanted to make, and we may have moved John past this, but I just need to air my view here, is we have a bit of asymmetry in that we're saying for services in kind, they only need to be recognized if they're critical to the mission, and otherwise it's optional. But with gifts in kind, there's not a similar out. We obviously have the requirement that you may not have to recognize the inventory, but we're still getting to a place where you have to recognize the revenue and expenses there. And I guess I'm just struggling in my mind to kind of think why we would have different outcomes, whether it's, you know, a physical good versus the service. So I just think we need to, maybe, as I said, maybe we've moved on past this, but I'm still kind of caught on why we have such different outcomes for the two.
Okay, thanks, Catherine. Daniel, welcome.
Hello, everybody. I think my answer to the question is definitely yes, because I think services in kind are critical, are very important to show the real performance of the entity. So I think it's very important to show that it could affect the reading of the real performance if we don't include those services in kind that are critical to the entity. Thank you.
Thanks, Daniel. So before I go to Tim, I think where we get to on this is there's a matter of tactics here. I think this is a microcosm. The contributions we've heard are a microcosm of the debate there will always be in this area. So it's about the drafting being sufficiently sensitive that we haven't just kind of gone down this route, and that we do get the SMC drafted right. I think the point about consistency that Catherine has made is very valid, and actually that's a strength of actually doing inventory, at the same time as revenue. So I think that's the other instruction there, is just actually to make sure that we've got the consistency, or we've rationalized why there is inconsistency, so that it appears that we have an integrated solution. Tim, and then I'm going to move us on.
Yeah, I mean, I think I support your approach of being propositional and seeing what that generates. And I wondered what my question was if there's anything coming out of the whole kind of integrated reporting side, because I heard very similar concerns in the past about valuing ecosystem services, and how could you put the sort of immorality of putting a dollar value on those sorts of things. But until people started putting dollar values on those things, then they weren't being recognized as making a huge contribution. And so I think this is quite important in the sector, because the failure to recognize agencies that rely predominantly on gifted services are not viewed as important as ones which have got large balance sheets and with it not being recognized. So I think it's important to generate the debate, but also maybe there's something coming out of that whole integrated reporting thing that we could also pull on as we're developing our guidance.
Thanks, Tim. I mean, I think on the integrated reporting, obviously that's fairly early days yet, in terms of the fact that the responsibility has been taken on by the IFRS Foundation, and I think they're still trying to work out how does this fit with general purpose financial statements versus general purpose financial reports, with sustainability and so on. So I think we're not going to have any clarity in that space for a while to come, and ISB is also looking at a bigger project on intangibles, and so there's a lot of different things to work through. So I think all of that says, actually, if we go out with this sort of, if you like, this propositional position, but make sure that we've got consistency, and also that we've nuanced in terms of the fact that we've had the debate, I think that's probably a reasonable way forward at this stage for the exposure draft. You know, and depending on what we hear back, we might well shade back. But it's as ever, actually, it's easier to go out harder and then shade back than to go the other way. So if we go with that, then are there any points on? I think, as Paul said, we've effectively covered question 7 earlier. Anything on question 8 before I move us on that?
If I can just come in there, Ian.
Yeah.
The focus group did just talk about gifts in kind, services in kind, and so there were some comments from those. So in terms of sort of the mission critical, what is material, guidance would be required. Does it cover administrative as well as program delivery tasks? And then another question was, what about the use of assets for no cost? So if you've given use of a building for a period for no cost, or use of a vehicle, which you then return to the donor after a program is finished, are those they're not really lease type arrangements because there's no payments, so are they donated services, or should we treat them as a property right? I obviously TAG members won't have had a chance to think about those yet, so maybe if anybody has any thoughts on those, they could provide feedback via email afterwards. There was also some suggestions that we do need to tighten up the exemptions for gifts in kind, just to make it absolutely clear that where we're talking about the sort of for sale items and for use or distribution, we're talking about items that do not that are not non-current items or are not high value items. It's only the lower value items that we're talking about in all cases.
Thanks, Paul. Just an observation on the lease type arrangements, etc. Of course, that's something that IPSASB is consulting on concessionary leases at the moment, and we have certainly had some a range of views on the approach proposed there. But also, I think the feedback statement on, you know, the kind of things that aren't technically a commercial lease subject to a lease contract. How could you approach those? Some of that may be useful, actually, Paul, thinking about it. Karen.
Yeah, I whenever anyone says the word lease, I kind of inwardly think, oh gosh, this is challenging territory. And I think also it's particularly challenging as well because in the ED of the 3rd edition of the IFRS SMEs accounting standard, it doesn't have the most up-to-date position on leasing in it. So in terms of what we will be taking forward into impact, because this is not a priority topic, we will just be rolling forward what is in the IFRS SMEs accounting standard in essence. So I think we need to think quite carefully about how far we can go with this, given that it's not an area that we're proposing to examine in detail, and of course it is one where there's still work being done both in IPSASB and of course not yet in the IFRS for SME standards. So a challenging area. We do recognise there are those kinds of things, and we'll just need to think about how we're going to handle them.
Thanks, Karen. And that may be where some of what's in the feedback statement actually to the exposure draft that went out alongside exposure draft 84 may be relevant, because more of those are actually examples of how you apply revenue guidance rather than leases, but recognising what we've said. Sam, final word, and I'm going to move us on.
Yeah, just a couple of things from the focus group. One was to specify that services from board members wouldn't normally be valued. They're expected to be free and not. And then the other one was about materially reduce the level of activities. Is it quantity or is it also quality? And perhaps that tightening of the definition could also include that aspect.
Okay, thanks, Sam. So Paul, move us on then to these questions.
Yeah, so I think Karen's briefly touched on simplification. We were proposing to sort of simplify part 1 by cross-referencing to the part 2 for more complex issues. So things like modification of a binding grant arrangement or modification of a contract, we would cross-refer to part part 2 for that. We've then provided sort of draft decision trees for any comments. Proposal to replace requirements on accounting for liabilities where there are no binding grant arrangements, just with a cross-reference to section 21 for provisions and contingencies to make it simpler so we don't have to replicate that. And then we had some revised terminology proposed in Annex D. Some of that we will need to come back to because we were talking about limitations and funding arrangements, which, based on feedback we've had since the papers went out and from the focus groups, we're now thinking about whether we actually need to use that terminology. So maybe we could think about question 12 once we've talked about the transactions, which I'm guessing will be towards the end of the meeting now.
I think the might be right on that one, Paul. So on questions 9 and 10, obviously there is some thought about, well, which way round the sections go and so on. But if anybody's got any points on how those are set up and drafted and so on, what I'd suggest is actually if you can drop Paul and Karen an email, just with those suggestions. Any comments then on question 11 in terms of the approach there and the cross-referencing? And then any questions on any points on the terminology point, always on question 12. Okay, so yes, as you foreshadowed.
Sorry.
Oh, sorry, Freddie, go ahead.
No, sorry, I just was raising my physical hand again, struggling to find the button. When I was looking at that, I think terminology, it just honed back the feel that we are essentially talking about very, very similar, if not identical thing, just using some very slightly different terminology, and that raised the question whether we should not combine those two. So just put it out there.
Okay, thanks, Freddie. I mean, I think that does go back to that earlier discussion, doesn't it, in terms of how you cope with, 1 versus 2 and so on. Okay, so with that, we are on time in terms of breaking at this stage. So we'll take a 10-minute break and then we'll come back and we'll look at the item 3. Recognizing we have got more material that we need to discuss, but on revenue, but we will hopefully find time for that at the end, depending on where we get to on the other items. So back here, and we'll carry on the hour, whichever hour it is for you. Okay, thanks very much.
You'll remember we had Chris Twagarimana on the tag representing the Institute of Certified Public Accountants of East Africa, who's from Miranda. He's left, and we consulted the CEOs of the 3 country professional accountancy organizations, and Catherine has been nominated from ISPAC in Kenya. And so you're very, very welcome, Catherine. It's fantastic that you can join us for your first of hopefully many more tag meetings.
Thank you so much. I'm really pleased and honored to be here. Apologies for the rough start when I joined the meeting. I'm in a place which is a bit unstable in terms of network, but I'm really happy to be in the meeting. So thank you. I'll be participating as we go along.
That's great. Thanks very much, Catherine. And you're very, very welcome into the group. And I know this week is difficult in terms of ACOA going on at the same time. So thank you for making the effort to join us.
Thank you so much.
Yeah, so with that, Phil, over to you and take us through the key questions.
Fabulous, thank you, Ian, and hello everyone. So some of what's in this paper is likely to be superseded by the revenue discussion later, as this section does try to mirror part 1 principles there. So I'm going to try and be as brief as possible, as decisions there are going to impact on grant expenses. So if we go straight into the substantive comments received from members on the guidance, firstly around the definition of a grant expense and issues around when a grant providing MPO might receive some value back, commensurate value, or there's nominal consideration. I think this is a similar issue to what we've just looked at in revenue. We agree that guidance is required for those situations where the grant providing NPO may receive some value from services, goods, or other assets being provided directly to it from the grant recipient in exchange for the transfer of resources. What we've proposed is additional text for inclusion in the application guidance that looks to draw a distinction between grant expenses where nothing is directly received and relationships that are more akin to procurement. Grant providing NPOs are required to determine how best to reflect the substance of the transaction. Where material, we've noted this may involve recognising part of the transaction as a grant expense and part as the procurement of services, goods, or other assets. So I think just the question is, do members agree with the responses to the substantive comments received? And do we have any comments on the new text?
Thanks, Phil. Jenny.
Yeah, it was just a comment on the text, Phil. I think, shouldn't it be, isn't it a sale? Aren't we talking here about where, rather than a procurement, isn't this where we've provided something and the recipient has paid, or maybe, unless I've misunderstood, but I think, yeah, the recipient has sort of paid part, a fee, so it's a sale, isn't it?
It's more like where a grant providing NPO has provided cash to another NPO or another beneficiary, and they might have received a service or good in return, but it's not of the same value as the cash. So I may have provided, say, $1 million in cash and got back $250,000 in consulting services. Effectively, I am providing a grant. I'm getting a little bit back, but clearly what I'm getting back is nowhere close to the amount I've provided to the beneficiary. So it's how best do we recognize that? Is it best to just show that the entire thing's effectively a grant, or are we saying actually we need to show $750,000 as a grant expense and $250,000 as procurement?
No, I was fine with. I was just wondering. Yeah, maybe I was thinking of the wrong example of when it was working. But yeah, I was happy with the idea of thinking that there's perhaps more than one activity going on here, and we might need to think about.
That.
Yeah.
Thanks, Sam. Sam, to you.
You're on mute, Sam.
No.
Sorry, it froze. I was trying to press unmute. Just in relation to what Jenny's example. So again, when we were in the focus group, I was thinking about an example of, say, a school that sells, school fees, if you like, but students pay much less than what the market rate is, and that the difference between fair value and what the students are paying would be considered as additional revenue, and the equivalent cost would then be some sort of grant expense at the bottom. So you'd be crediting income, debiting expense. Or not? Have I misunderstood that?
I think on that example we discussed it. I think the substance of that one is the NP of the schools getting grant revenue and commercial revenue, and its costs are just its costs. In terms of expenditure to provide that educational service, if it's $100,000, it's $100,000. It's on the revenue side where you'd show that effectively you've got the subsidy of school fees, but the expenditure should stay the same. So if it's $50,000 of revenue from school fees, $50,000 of revenue from grant, you've still got $100,000 of expenditure on salaries, books, electricity, maintenance. I don't think we'd gross up the expenditure there.
Okay, then I've misunderstood the thing. Okay, that's great. So it wouldn't result in a grant.
No, I mean, it's the issue we've got that we have to take this in the round, I think, with revenue, and we need to very accurately mirror the proposals in both sections to make sure where we do have these complicated mishmashes of activities, grants, expenditures, that we can show the revenue, economic substance correctly, applying both sections.
Okay, thanks.
So with that, with both points, I think if there's anything, having had a further reflection, either Jenny or Sam, that you think needs to be clarified in the drafting. Probably if you go back to Phil on that, it's probably the best way forward. So I think move on to the next point then, Phil.
Okay, so the next substantive comment was basically we had a lot of guidance in a single paragraph, and I appreciate there was a lot because we'd included the recognition and measurement principles together for transactions where there are no binding grant arrangements. So we've taken that on board and split those into separate paragraphs and also revised the decision tree to update for expected terminology and concept changes to match revenue, which may actually no longer occur depending on later discussions. But effectively, we've split recognition and measurement principles. And are members happy with that? And do they have any comments on the new text?
Okay. Not seeing any hands raised on that, so I think we're good on that. So move us on then.
Lovely. Next was foreign exchange, currency translations, gains and losses. Effectively, the text we had was out of date to current proposals just because of the way that the FX foreign currency translation guidance had been developed in the discussions. So we've now updated the text in the grant expenses section to clarify that assets or liabilities denominated in a foreign currency that are non-monetary items should be measured at the reporting currency at their historical cost, using the exchange rate at the date of the transactions. Those that are monetary items will need to be restated into the reporting currency using the applicable exchange rates at the reporting date. But whether members are happy with the response and comments on the new text, if any.
Thanks, Phil. Any responses to that? Okay.
Lovely. Next was around implementation guidance and examples. Member noted that our sensitive information text didn't fully include disruption to operations. So we've amended the text to make that clear. And we've also changed one of the illustrative examples, which was potentially, I hate to use the word sensitive again, but potentially a sensitive example in times of COVID around zoonotic diseases. So we've just basically changed what the example is around. So again, our members happy with the responses and any comments on the new text?
Thanks, Phil. Okay, not seeing any hands raised, so we're fine.
Lovely. So those were the main changes to the text. There's then two areas where we'd appreciate further input from TAG members. The first is around the recognition of a grant expense on the transfer of resources, which is measured at the carrying amount of the previously controlled resources. This has been the same proposal throughout and mirrors what's in the IPSAS, but we've never explicitly discussed it. And I think the two Jeffs raised it and asked, would we not change the carrying amount of the resources to fair value before transfer? So effectively, our members happy that it is whatever the carrying amount of the resources in the grant providing MPO's books, and that there is no requirement to change those to fair value before transfer.
Yeah, Catherine, then Jenny.
Yeah, I agree. I was only just going to add that I was actually trying to think this through if you did mark it up to fair value, and I think it would all just end up washing out through the P&L anyway. So it just seems like to require fair value measurement would be a lot of work with not necessarily much impact. So just wanted to add that.
Thanks, Catherine. I think that's a good point. Bear in mind, Jenny.
Yeah, I was thinking about it too, and I was thinking, well, obviously you've got to de-recognize whatever it is you've given, and in some cases the book value and the fair value may not be dissimilar. But I was thinking if there is, and it maybe doesn't happen very often, but where you have got something that its fair value is significantly more than the sort of the value of what's been given, of course, is much greater than what you're then recognizing as the cost. And so I was thinking, potentially there's something not being captured there if you, but it would only be presumably most likely to be sort of long long-lived assets, and I don't know how often that happens. And then sort of what you'd have to do, I guess, is have a requirement to revalue immediately before you you made the transfer, and then obviously the amount you're de-recognizing, and then it would, of course, as Catherine just said, it'll all come through the income and expenditure statement. I wonder if there's something around, if there is a significant difference between book value and fair value, whether there's a disclosure requirement to recognize that greater value that's been given to the recipient. But it was just a thought.
Yeah, because my thoughts, it would be potentially, say, if you donated or gifted a building to an entity and you held that building at historical cost, but its fair value was significantly higher, presumably you would already potentially be making that disclosure that you have a building whose fair value is a lot higher that's in your books, depending on our approach to property, plant and equipment. But a kind of disclosure around that, potentially. I mean, it's something we might want to ask on in the exposure draft.
Yeah, it's kind of an IFRS 5 situation, isn't it, really, that you're talking about? Do you want to reflect on that one, Phil? Because I think, you know, probably it is going to be quite rare, and it's a sort of how you actually address that, because I think practically, I think you go back to Catherine's point that most of the time, actually, you don't want people fair valuing just for the sake of a book entry that washes through. So, you know, I think it is, and it might be worth actually just having a look at those, you know, the criteria that are in IFRS 5 in terms of, you know, held for sale and what that means and so on, because that may rule it out, as it were.
Lovely.
Okay.
Yep. And then if everyone's happy with that, the final area for input is around sensitive information. And one member raised the point, would we include information that could cause reputational harm to the NPO? And I think the Secretariat's position is that we'd be worried that might be extending the sensitive information exemption a little too much. And there would be a fairly significant risk that transparency could be limited, to the extent that if you're saying, well, I've given this grant expense to another NPO that's totally misused it because of terrible failings in my own internal controls, that will cause me reputational harm. So I'm not going to disclose that grant expense actually was misused. That would be my concerns. So it's whether other members share that view. Or is there something we could do around disruption to operations that could bring in potentially something where it's not going to limit transparency that much, but would take into consideration that view?
Thanks, Phil. Comments on that, Catherine?
I think this was my comment originally, so I'll get in here on this. So my thinking around this was just in terms of how we've defined the sensitive information exception currently, where if it's a disruption to operations. And the reason why I thought we might, it's not that I think we need to, I'm okay if we don't include sort of the reputational damage, but I think for an organization like a foundation, again, coming back to that example where their core activities are fundraising, then by the way that we've defined what the sensitive information exemption is this getting captured in that anyway? So I think it's we either need to allow this to happen and maybe be explicit about that, or do we need to tighten up what the exemption is so that if we don't think this is the way forward, then that gets excluded. So I think I think there's an interpretation that it could be captured based on how it's currently drafted. So I think one way or the other, we just need to make sure that we're clear. And I'm not fussed if the decision is to not allow it, but it could be captured currently.
Thanks, Catherine. That's helpful to hear that clarification. Does anybody have any comments in terms of what's proposed at the moment? Karen?
If I can feed in the two Jeff's perspective on this, they are of the view that reputational harm should not be included. Their feeling was that broadened the definition too widely. So that was their perspective.
Okay, so that would argue for Phil, if you can work with Catherine then on just tightening the drafting.
Well, I think when we look at the feedback we've had on narrative reporting from ED1, we will need to look at sensitive information and make sure it's very clear what we mean by the disruption to operations, because you could take it in a number of ways, and I know what way we thought we were putting forward, but I mean, effectively, reputational harm could fall into that. So, yeah.
Okay. Well, if we take it forward in that way, in terms of the crosswalk, but also just making sure that we've addressed the point that Catherine made in terms of tightening up the drafting.
Yep. And that's grant expenses.
Great. Okay. Thanks very much, Phil. So I think then we move on to foreign currency. And Karen, you've picked this one up.
Yeah, that's correct. Thank you very much, Ian. And you'll notice that Nigel is not on the call today. Unfortunately, for ill health reasons, he has had to leave SITFA, and despite the fact that he was actually enjoying foreign currency, and there's not many people who can say that. But I have picked this up. So the what's in this paper actually is much more about the conversation that happened at the last TAG meeting at the end of March, rather than the feedback on the draft, because the last meeting in March overtook the drafting that we had circulated. I think it's fair to say that since that meeting there have been some evolution in our thinking as well. But what is captured in this paper really is about confirming the implications of the discussion and the way forward from the last meeting, and how we build on that. So the first three questions really are about the drafting in the core guidance, and in particular about the presentation of exchange gains and losses, where they relate to a grant that has restrictions. And the drafting has been updated to clarify that essentially the presentation of the exchange gain or loss follows the treatment of the underlying transaction. So if there is a grant that is presented with restrictions that subsequently has an exchange gain or loss, that exchange gain or loss will also be presented with restrictions. So the text has been updated to reflect that, and it removes the text that was previously there about remeasurement of non-monetary assets and liabilities as well from binding grant arrangements. So the first question is about the revised text in 3012. Question 3 is linked to that as well, where in drafting this, we have carved out the text in G3015, which is about foreign exchange gains and losses related to controlled entities. And we've retained that drafting in there to make sure that there is a carve out of that if needed. But we were struggling to think of examples where that might apply. So question 3 relates to that. And the question 2 in this block is the other change that's in the drafting of the core guidance, which relates to the disclosures of the impact of exchange rates on grant arrangements, and the need to show separately the impact of those on individual arrangements. And the question is about whether the TAG agrees with that, or whether there is a view that that is too complex in relation to the potential benefit that can come with that. So that's the first block of questions really, which is about the core guidance. pause at that point.
Thanks, Karen. So open for comments. Okay. So I think everyone's okay with the proposals there, Karen. So,
Excellent. Okay, I shall move us on then. So the next two questions are about the application guidance, which there's been some significant redrafting to reflect the discussion at the TAG. And the key areas that have changed are shown in an annex, in Annex A. So there's an excerpt there, not the whole thing. The key points in there are about confirmation that binding grant arrangement liabilities are non-monetary liabilities, and that's consistent with the drafting in the other sections. That an expenditure obligation that arises as a result of a change in exchange rate will need to be recognised as a provision for an onerous arrangement. That where there is an obligation to repay, that will decrease the amount of revenue that was initially recognised. Decreases in the amount of spend that arise because of changes in exchange rates don't require any action at all, and that exchange gains and losses, as I've just described on monetary items, will get presented with restrictions. So those are the key changes, and just calling out a couple of things in there that's just confirming that everyone is happy that binding grant arrangement liabilities are non-monetary. And the second part of that is also confirming what was discussed previously about where changes in exchange rates that create future spend obligations are treated as a provision.
Thanks, Karen. Any comments on that? Okay.
Okay, I should keep going.
Oh, sorry, Sam.
Thank you. So I'm slightly scared to ask a question in case I sound really silly because I've misunderstood something. I wonder if everyone else having that feeling too. It's so complicated. But my question is about where you have a funding arrangement. So it's not a binding grant arrangement. You've got some income, you've spent some income, but that income came in foreign currency. There's no obligation to deliver specific outputs or deliveries, but you are required to spend the money they gave you. That's the nature of restriction. And from a donor's point of view, if they gave you $100,000, you have to report back to them that you've spent $100,000, even if your ledger is in a different currency. So at the end of the year, you've got, I don't know, an unspent, unrestricted, a restricted fund balance in relation to funding agreement of $80,000. But it's held in local currency as the difference between the income that you recognize and the expenditure that you spent in local currency. And then you've got year end, and the value of the dollar has changed against your local currency. So it's kind of a monetary, well, this is my question. It feels like a monetary balance, and yet it's not an asset or a liability. I was just reading in the paper, you said a decrease in the amount that has to be spent is recognized as a decrease in expenditure. And I'm wondering if that speaks to that specific problem, or if that's a different problem and how that would be addressed.
So if you have money in a bank, and I'm not, maybe we take this offline, but if you've got money in a bank account that's held in a foreign currency, then that's cash, that's an asset, it's a monetary asset, and so you would retranslate it. If you've got money that is on a funding arrangement and it's unspent, it will just carry forward until it's unspent, until you have spent. But maybe we need to take this offline, because you're right, these are really quite complex transactions, and it's probably quite a neat segue into the next part of the paper, which is about the illustrative examples. They have all been updated to reflect the principles that I've just outlined. I think since the tag paper came out, I've been through some of the examples again and realised that a couple of them still aren't quite right. So if you have got comments or observations on them, I would be incredibly grateful, because this is quite a complex area, and so I will be making further updates to them, having tried to apply some of the things myself and not found that there are a couple of gaps. I think it's really important as well that we've got the right examples, and maybe Sam, the question that you've just asked me is a more common occurrence that we need to cover in the examples. We are holding a focus group on this next week. And so we are asking the focus group members about, actually, have we got the right examples? Do they reflect common situations that NPOs find? So we may have some further iteration of the examples once we've had some further feedback on that. But it's an area where we're keen to get feedback about the understandability of what's there and whether they capture typical kinds of transactions that people have.
Thanks, Darren. Yeah, Catherine.
I guess just first, I wanted to say I really like the new approach. I think I found what we had discussed in March very confusing, but I think this simplifies it. The one thing I wanted to point out, and it's kind of within the examples, but it relates to the exchange effect on cash. And what I know from certainly the not-for-profits in our country is that oftentimes cash is very commingled. Even amounts that are restricted or for a certain purpose are commingled with other funds. And so I wonder, and maybe this is something that's explored with the focus group, but the requirement for the exchange portion on the cash to go through to the with restrictions category will be challenging or near impossible. I think it makes a lot of sense for all the other balances that are getting translated, because those are very discrete. If you have a those types of obligations, but the cash I worry about, and whether that's actually going to be a feasible thing for a lot of organizations to do, to figure out what the exchange rate is on, or exchange is on the cash piece.
I said thank you for that, Catherine. I wonder whether you were listening to the conversation that we had earlier this week, where we were discussing exactly that point. So we'll certainly be teasing it out in the focus group, and that we're certainly looking, if nothing else, whether there should be something in the illustrative examples that explains where you've got one foreign bank account that covers multiple agreements. And you're revaluing the whole thing. How do you deal with that? So we'll certainly be looking at that and following that through. So thank you for raising that.
Good. Okay. And then the final question is around the update on basis for conclusions.
Yeah, correct. That we've had a significant rewrite to the basis of conclusions to reflect the discussions that have gone through the tag and where we've got to now. So we just very much welcome feedback about whether that reflects the discussions that have taken place.
Any points anybody wants to make? Good. Okay. So thanks for what you've done on that one, Karen. It's an incredibly complex area.
Yeah, it certainly is.
Okay, so then move us on to item 5.
Yeah.
In terms of updates on other non-prioritised topics.
So that's myself as well. So just a few things to pick up on this paper. So it's very much exception based in terms of the comments that have come up. The first 2 questions are around the response to feedback on the consequential amendments to section 6. We were looking to put through consequential changes there to deal with movements between funds with restrictions and the funds without restrictions. That was the key focus of it. There were some suggestions that came back in terms of tightening up the wording and be clear about exactly what we wanted. And as a consequence, we've changed sort of analysis to an explanation. I think it's really what we were looking for as parts of this section. So there's some updates to the drafting to reflect that. The other key area that came up is in relation to capital items, and particularly in terms of the drafting that would on completion of the purchase or development of a capital item that was funded through restricted monies, but there are no ongoing restrictions, where we're suggesting that then gets transferred to funds without restrictions. There was a question about to what extent would it be useful for users to understand to what extent there were assets that had been funded with restricted funds. So there is a question about that as well. And I have to say, this was the section that generated most not necessarily differences of view, but questions about, well, how different is capital to capital is very different. So it would be good to see if there's any feedback on that.
Thanks, Darren. So any points on questions 1 and 2? Okay. Let's move us on then, Darren.
Fabulous. The next question is a bit of light relief from all of the technical stuff. Which I have to confess that I've noticed is we have a growing proliferation of hyphenation in terms of our terms. And I think the question was, well, when do we hyphenate and when don't we hyphenate? And should we have a protocol around this so that our words don't become longer and longer in terms of hyphenation? If so, that's just a very light relief question to get people's views on this. I'll throw in at the staff, the 2 Jeffs did have a view on this, and their view is that the protocol that they use in the US could be appropriate, is that where you are modifying a noun, you hyphenate. If you're creating a new noun, you don't hyphenate. Was their suggestion. So I don't know whether anyone else has any other thoughts around what might be an appropriate protocol for hyphenating.
Or perhaps any objections to the approach suggested by the 2 Jeffs. Okay. I think we'll go with that in terms of any different strategic view. Right.
Thank you very much. Excellent. The next question is about section 11 on financial instruments. There were a couple of points that were picked up here. One was that there is, I've lost the reference to the paragraphs, but there were references in there in 11, 6E and 60G to share-based payments. And given that we've removed it elsewhere, a proposal that should be deleted, completely agree with that, and then propose to delete that section. The other question came up about where there is also reference to equity components of compound financial instruments. I have to confess that compound financial instruments are not my specialist topic, and so before I took a red pen to it, I wondered whether TAG members had any views on whether there would be such equity components of compound financial instruments. So about others' expertise in this.
Nobody's stepping forward. Oh, Daniel,
Oh, Daniel, excellent.
go for it.
I think this is a topic that is, it would be very, very rare, very strange for an NPO. So I think I can't imagine a situation when an NPO would have a compound instrument. So I think it's not an important topic for an NPO.
Okay, thanks, Daniel. Jenny.
Yeah, I think the share-based payment one seems fairly straightforward to take out, doesn't it? On the compound one, yeah, it seems like it would be something that would be rare. The only thing I was just thinking was, if it did occur, would people be able to? Is there anything in the drafting that would sort of prevent people getting to the right answer using the hierarchy or something? Because if there's nothing, if they could just go and look to IFRS to get the right answer, then that should be fine. But if there was something in the drafting that sort of somehow prevented them doing that in this particular case, we might need to think about again, it seems like something that would be rare, but that was just one thing to think about, that can they get to the right answer if it is silent?
Yeah, thanks, Jenny, for that point. Catherine, and then back to Karen.
This reminded me, this question, of the conversation that we had back in September around equity on the balance sheet and within net assets. And I think where we got to on that was equity was referenced, but it was sort of reduced in prominence. And I would think that we aren't necessarily, I don't know if we'd gain a whole lot by deleting these paragraphs. But that said, I think to Jenny's point, I think you could find a way through the guidance to find something if you think you need it. But since we did include equity as sort of a concept, we aren't entirely excluding it from as a possibility here. So I think from the same view that we kind of took on that went out in exposure draft 1, that it should probably be here as well.
Thanks, Catherine. So I think where we get to on that is we shouldn't rule out that we should be silent effectively, and that's to Jenny's point then, that people can get to it, so we don't rule anything out. But Karen, does that make sense?
Yeah, no, absolutely. I mean, I think on the share-based payments one, which I think, as Jenny said, I think is more straightforward. We do specifically now talk about the link to the hierarchy in that. So there's definitely, we're signposting the way back to the hierarchy to find it. The equity one is probably a bit more of a work in progress for that. And you remember we deferred the section on liabilities and equity to ED 3 so that we could see the feedback from ED1 and give further consideration to that. So maybe the best thing to do for now is to leave it and see what comes back in our analysis of ED1 and further considerations for ED3 and reconsider it at that point.
Okay. And then at least we put it out.
Yeah.
I mean, we could even ask a question about it, actually.
Yeah.
Okay.
And then just a couple more bits on section 13, which was, I think we got we got out of sync with the basis for conclusions, and we hadn't accurately updated it for subsequent discussions about grant payment assets and liabilities. So we've updated it for that, and we've also updated the illustrative examples that effectively cross-refer to section 24 and don't ask for anything specific, but just say that they are the kinds of things that you might disclose. So just updates to reflect and bring everything into line.
Thanks, Karen. Any comments on that? No? Okay. That's good.
The next question is about section 29. There were a few comments on this section with some of the questions about, well, actually to what extent do we think this section is going to apply to non-profit organisations, and do we need to signpost anything up front about the extent to which this section is going to be used? And then there was a final question about the paragraph relating to tax on distributions, particularly given that we don't think that distributions are going to be a feature of non-profits, particularly in terms of dividends, which is where tax normally applies. And so a question about whether that paragraph is going to be needed in the section.
Okay, thanks, Karen. Jenny, to you.
Thanks. I was just going to say on the tax point, I mean, it may not occur because there may be other arrangements, but of course, where you've got NPOs that have subsidiaries, those subsidiaries could be profit oriented, and obviously depending on the circumstances of the subsidiary and the tax laws in the relevant jurisdiction, you know, there could be tax in a it seems not impossible for there to be tax in a subsidiary that could need to be reflected then in group accounts. So that might need to be considered.
Yeah.
Okay, thanks, Jenny, for that point. Okay, so move us on then, Karen.
So I think Sam's got a hand up.
Yeah, just it's very common in Africa and elsewhere that non-profits are subject to tax. You have to apply for an exemption. It has to be accepted. You'd have unrecoverable VAT, you'd have income tax, all sorts of taxes. So it's certainly applicable to many normal non-profit entities in other less positive jurisdictions, shall we say.
Okay, thanks for reminding us on that, Sam. That's really helpful.
The next part of the paper then covers the proposal to include inventory in ED2, which we touched on earlier in the discussion. The concern in adding in another substantive section is that it will make ED2 somewhat longer in length and more material for those who are responding to engage with. I'm therefore proposing that we take something out to enable inventory to go in. The proposal in the paper is to remove section 11 on financial instruments because it's quite a technical section, and for those that are engaging in it would take an amount of resource, and certainly it would take a number of pages out that make it visually not so challenging as well. The counter to that is that references to section 11 are made in some of the other sections that we're providing as part of this ED, including 23 and 24. So we could take out other smaller sections, but it would need to be multiple ones. But I think section 11, in terms of the balance of the material, is what we're recommending. We're seeking views on that.
Thanks, Karen. Anybody disagree with Karen's proposal there?
And just a quick question, we don't make any significant changes and anything NFP specific into financial instruments in any case, right? So
yeah, so where we've landed on financial instruments, we are proposing the terminology changes to, as we've just described, actually take out a couple of subsections, and there's just a couple more examples of things that you might disclose relevant to section 24, but other than that, there's nothing changed, so there's nothing major missing.
So yeah, I was thinking that yeah, that can be viewed from both angles, but it saves time to get through, and if there's nothing controversial, can go into ED3 without kind of bringing it forward for any specific reason.
Yeah. You're on mute, Ian.
Fine. Yeah, so thanks for that. So I think that gets us there then, Karen.
There's just one final question, which is about the new tables that have been added about the comparison tables to IFRS for SMEs, and also not in the question, which should have been in the question, was also about the proposed SMCs as well. In terms of whether they seem to cover the right grounds and pick up the key points. We can deal with drafting changes offline, but really wanted to get to whether they seem to cover the right points.
Okay. Any comments you need to deal with? Okay, that's good. I think one thing I should preface the right up front is thank you everyone for the, all the excellent comments that you provided us with. It's fantastic actually what you've actually done, and I think that's really contributed hugely to the quality of the final product. So just thanks on behalf of the Secretariat for everything you've done. Okay, so with that, we then move on and we start to look forward to ED3 and some of the other things we're going to have to worry our way through for ED3. And Phil, this is over to you for this.
It is, yes. So welcome to Exposure Draft 3, everybody, while we're still dealing with 1 and 2. So classification of expenses. Consultation paper put forward a description of the issue and possible alternative treatments. Respondents were generally supportive of the description, the list of alternatives, and the advantages and disadvantages articulated. Third alternative was split between requiring both a natural and functional analysis or following international standards that provide entities with a choice. Number of practical issues relating to implementation were noted by respondents, particularly capacity and capability of some NPOs to undertake functional analysis. And this was one reason why many respondents who did support alternatives that included functional analysis felt it may only be appropriate for larger, more complex NPOs. But as we've seen, there's difficulty arising in deciding actually what is a large and complex NPO and what thresholds should apply that would require NPOs to undertake functional analysis or a hybrid approach. Conscious of time, I think it's just a very brief introduction to what was in the various descriptions and the responses. I think if TAG members have any comments on the feedback that have been provided by respondents to the SMCs or the views that have been expressed by the Secretariat as to how we'll respond to them, we should take those now.
Okay, thanks, Phil. So open up for comments. It's really been a tricky one in terms of deciding the way forward on this. I suspect we will not please everybody, but anyway, any immediate comments on what you've seen summarised there? Okay, Phil.
Lovely. Okay, so we can move straight.
Sorry, I think my brain was whirring slowly. On discussions with Tim actually earlier, thinking about function analysis could be quite complicated, but the 3 big buckets that people are most interested in are program, overheads, and capital. And if we could get the split between those 3, right, more nuanced split between different types of programmatic activity. And many organizations do that already. Some sort of split between what we do is direct, indirect, and capital. That would give that would be of value to nearly all organizations, whereas more involved, onerous, burdensome function analysis might not add much additional value. But getting those 3 buckets clear really could add value even to smaller organizations. I'd like to nuance that a bit.
Thanks, Sam. And in a way, that starts to look forward to the next item on fundraising as well. Phil,
Yeah,
so useful then into sort of, you know, how we start to think about this. But I think
So
Sam's comments are very important.
Yeah, so it does link quite neatly into the way ahead, actually. So there's no clear view from consultation respondents. Since the publication of the consultation paper, we've also started to develop proposals for a potential supplementary statement, which will include some functional information, particularly around support costs. So taking respondents' views, the potential for that statement, I think the Secretariat considers there'd be benefit in considering in more detail recent developments by the IASB on its primary financial statement projects, which following redeliberation we expect might allow a natural analysis, a functional analysis, or a mix of the two, and provide guidance on natural expenses that must be presented when a functional analysis is chosen. So I think we're going to explore the implications of this for MPO financial reporting, examine if a mixed approach would be appropriate for MPOs. If so, would there be a minimum set of natural cost information that all MPOs should show? And if so, what natural costs and how should they be represented? Similarly, on functional information, as Sam's just noted, would we require, say, support costs to be shown for all MPOs? How would those be defined? What guidance would we need to provide to identify functions and principles for allocating those costs? And the extent which we need to take into consideration the presentation of fundraising costs, which we'll cover in the next paper. So our proposal effectively is to look at those recent developments by the IASB, and we will be looking at MPOs in more detail and what makes sense effectively from an actual functional and allocation perspective.
Thanks, Phil. Karen.
So if I can just play into that, the view of the two Jeffs, I think they think that is a sensible way forward, and in fact, and also I think FASB have got a similar project, so it's an approach that they recognise. I think the big thing that they wanted to call out was cost benefit, where there are any mandatory requirements to make sure that we we had thought through and didn't create, if you like, a long shopping list of things to be disclosed to ensure that it was manageable for MPO. So I think there's lots to be done, but I think that was the concern they wanted to put on the table at the very beginning.
Thanks, Karen. I mean, I think given the diversity of the sector, it's really important that we do think it through. Okay, Catherine.
Yeah, I just wanted to indicate my support for the proposed way forward. I think I would struggle if we're starting to develop requirements for the primary financial statements that are more onerous than IFRS. So I would focus on sort of keeping alignment with sort of the most onerous level there. And then to the extent that we think there are other not-for-profit specific information that should be disclosed, that we should be looking at the supplementary statement for that. And that probably is a bit of a teaser for my comments on the next paper around fundraising costs, where I think that that's probably the more appropriate place for that type of disclosure, especially given the judgment and that's required.
Thanks, Catherine. Any other points on that? Okay. That's good. Well, I mean, I think probably the main steer coming out of this is that there is going to be a need for optionality. Or one size fits all is unlikely to be the route through. So almost actually we need to travel with that in mind, I think. Okay.
Excellent.
So you move on to fundraising now then.
Yeah, and fundraising costs. So again, related to exposure draft 3, again, the consultation paper put forward a description of the issue and possible alternative treatments. Those treatments would allow either MPOs to continue to develop their own policies on treatment using any international framework with additional guidance provided, requirement to follow only one international framework with additional guidance and a requirement to disclose accounting policies, or the development of new MPO-specific guidance requiring fundraising costs to be disclosed. Again, respondents were supportive of the description, the list of alternatives, and the advantages and disadvantages we articulated. There was, though, a fairly strong view expressed by one or two respondents that fundraising costs are not the only factor in assessing efficiency, and that they can be hard to assess, and that for them it might be better to view fundraising as a whole organisation activity and just report expenses with other general expenses by nature, although that was a minority view. Most popular alternative put forward was the development of a new NPO-specific guidance, although it was recognised that diversity of NPOs meant this might be difficult to achieve, which might be an understatement. All respondents agreed that fundraising costs, however, should be presented gross. So again, I think if we can move straight on to the first question, any comments on the feedbacks provided by respondents and any comments on the views expressed by the Secretariat as to how we'll respond to them?
So, Catherine, I think you trailed your comments. Any other comments on that?
I was just reflecting at the moment in the supplementary statement, we don't have fundraising, and it might mean that we would need to amend that to be consistent.
Yeah, I think that's right. I mean, might be worth just saying as an update on the supplementary statement, we've started to discuss options in terms of positioning of information between an actual supplementary statement and what could go into the main general purpose financial statements. And we had an opening discussion with some of the auditors on the PAG yesterday, just to get some views on impacts of where nature and positioning of information might have on additional costs of audit, which I think was sort of in line with some of the comments raised at the last TAG meeting. So I think what the conversation we've just had also plays in with that, and it emphasises it's actually going to be quite tricky to get a clear-cut decision. The way forward we're going with the auditors is actually just to get some idea of the pros and cons of the different options from them before we circle back in terms of formulating proposals. So that's also kind of going on in the background at the moment, if you like, before we come back. Okay. Phil, anything else from your side?
No, so just the way ahead, as we just discussed with the classification of expenses, we're going to explore the extent to which a mixed approach, combining natural and functional cost presentation might be appropriate. Whichever classification approach we do deem appropriate, given the feedback and importance to the sector of fundraising costs, it's expected that that would be a specified activity that needs to be presented either on the face of the statement of income and expenses or through disclosure in a note. If that is the case, guidance would need to be provided on the principles for identifying and allocating costs to fundraising, especially where such costs are shared between fundraising and other activities of the NPO, where some might be seen as actual fundraising and some might actually be seen as the provision of a service or outreach activities that are actually sort of like more like a charitable activity than actual fundraising itself.
Okay, so thanks for that, Phil. So with that, we've now cleared 25 minutes in terms of agenda time, and we welcome Paul back to the hot seat. So Paul, we left a number of things hanging from our earlier conversation, so back to you.
Thanks, Ian. The two areas that we hadn't covered in the paper were binding grant arrangements and revenue with restrictions and revenue without restrictions. Clearly, there's some linkages between those. The issues in binding grant arrangements were definition of a binding grant arrangement, definition of funding arrangement, and same with compliance obligation and limitation. We had feedback from the focus group at the start of the week that actually there were going to be some transactions that fell between those current definitions, that we hadn't captured everything. So I think we do need to look at things again. We've also had feedback elsewhere that perhaps we don't need the definitions of funding arrangements, limitations, that we can manage without those. So rather than go through the paper, we'll be looking at those. One of the things that did come out of the focus groups are that a number of NPOs appear to have agreements with donors that include conditions that look like compliance obligations, so quite detailed, but where those agreements are actually not legally binding. So they wouldn't meet the definition of a binding grant arrangement, therefore wouldn't give rise to a compliance obligation, but there's enough detail in there that, you know, they look very similar. So we would, you know, and that wasn't captured in our definition of binding grant arrangement, funding arrangement, compliance obligation, limitations. So we had those type of gaps that we need to address. Revenue with restrictions and revenue without restrictions. There's the question of which transactions should be within which of those, within those two sort of presentation boxes. Binding grant arrangements, I think there seems to be sort of general acceptance that anything that's part of a binding grant arrangement should be within the with restrictions box. But the question then is, how do you treat those arrangements where there are things that are quite specific about what the NPO has to do, but which aren't either not binding of grant arrangement or are not compliance obligations. We talked about this diagram previously, so I'll skip on past that. So try to think about where each transaction should go. And this will sort of, I think, then help Secretariat firm up the drafting. We've got some scenarios here. How do you want to play this in? Do you want to go through each one by one, or just take a few of them together?
Well, I was just wondering whether we take any general comments before we get into the examples, Paul.
Yeah.
So you might just want to flick back to that slide where you use some the one before that, I think, because it is complicated. Certainly, we spent a lot of time going around this. Karen, did you want to say anything before I go to Freddie?
Yeah, if you won't mind. I mean, Paul there has kind of talked about the binding grant arrangement, funding arrangement, compliance obligation, limitation. The reason why we've got those new terms in there, funding arrangement and limitation, from the last iteration that you saw, was because we had a lot of feedback on the draft we circulated that things were not clear, and particularly the word restriction was causing complications in understanding about where that fitted in. So, you know, if something had what people would commonly understand to be a restriction, but it wasn't a binding grant arrangement, where did it go? And I think people were having difficulty in following the drafting around that. So in the paper that you had, we did look at these new terms, and as Paul's quite rightly said, the thinking has evolved. But just to clarify where those terms came from and why we were considering them in the first place, was to try and provide some clarification about, you know, what are those things that we would commonly understand to have a restriction but not a binding grant arrangement, and how does the whole landscape fit together. And that's really sits at the heart of the issues that we're trying to work through right now. So I just thought I'd add that bit of context.
Thanks, Karen. Freddie, to you.
So when I was thinking about funding arrangement or agreement, I think it took me back though to understand the other graph which we have on, which is on this next slide, a difference between 15 and the binding arrangement. And if I understood correctly,
just put that up, Paul. Just this context for Freddie.
Yeah, that this one, the nested diagram or whatever it is. It's essentially, if I understand it correctly, that the compliance obligation is broader group as it's illustrated here, because the binding arrangement would include legal and equivalent means, whereas 15 is only legal means, put it that way. Now, in our appendix to IFRS 15, the local one though, we do use term legal and equivalent means. And if I'm thinking about it, ultimately everything is legal, and ultimately it's all, well, at least in our jurisdictions, for the courts to decide. So I don't know right now what would be the local interpretation of legal versus legal and equivalent, and how that different is. And because then I'm not sure how then really the performance and compliance obligations are different. Not sure whether funding arrangements or agreement definition results in anything, or, and if it does it go into a recognition of obligation but in absence of anything distinct and present obligation? And then don't we have enough already in a suite of the standards in terms of the provisions, etc.? And or are we introducing something else, and then is it in line with conceptual framework? And those were the questions that I had in terms of funding arrangement, but it was coming back to, I was not sure whether what that distinction between the two terms, legally binding and, or legal and equivalent versus legal, what the true difference is really.
Thanks, Freddie. Yeah, and it will vary between jurisdictions, obviously, depending on how. Karen, did you want to come back on that before I go to Eastern?
Sorry, yes, please. So it's Freddie has prompted me to add something that I should have said earlier on, and I wouldn't have said anything different to what Ian has just said in terms of the difference between legal and legal and equivalent. The point that I should have raised earlier, just to factor into this, is that one difference that we have that isn't in IPSASB and isn't in IPSAS and isn't in IFRS is that we are looking at fund accounting as part of what we are doing. So fund accounting means that we need to be clear in the presentation of funds, what is a fund that would be a fund with restriction, that means that we can present it in that way, and what is something that wouldn't be a fund with restriction. So we've got the accounting issues in terms of recognition and measurement to deal with, but we've also got the fund accounting lens to contend with as well, in terms of what does that mean for the presentation of the information in the financial statements. Apologies, I should have said that earlier, but what you just said, Freddie, triggered me to say.
Okay, thanks, Karen. So I think I'm just going to carry on round and just get comments and interventions. Easton, to you next, and then Bileng after that.
Yeah, so I was just gonna, I think that diagram that's on the screen, I can only speak to IFRS 15 and what we put in the IFRS for SMEs, but I think the notion is the contract can be, well, has to be enforceable by law, but actually the performance obligations within it can be implied. So that notion of every performance obligation being enforceable by law or being legally binding, I don't think that's quite what IFRS 15 says, and you could get a notion of a performance obligation being identified within a promise that is only implied, isn't explicitly mentioned in the contract, and therefore might not be seen as enforceable by law, given that it's not been written down. So I think there's probably a bit of variation, which might actually be helpful as you move up to that next stage, when you consider it in the scope of these legal and non-legally binding present obligations, maybe some of that variation actually sits within IFRS 15 that would be useful to explore.
Thanks, Easton. Elaine, to you.
Thank you, Ian. Just to share some issues that we heard on the ground, perhaps can relate to this legal and equivalent means. I think quite similar to what Freddie have raised. As all of us know, in IAS 12, there's this enacted or substantively enacted. So, when we try to seek legal views on that term used in enacted or substantively enacted, so we will inform that in legal terms is either enacted or not enacted. There's no such thing as substantively enacted. So I'm trying to relate the issues quite similar in this sense here, legal and equivalent. What does that mean? We need to be really careful. But if you go to the lawyer will say that that's your accounting world. It's not in the legal world on that that matter. So just to be careful on things, on terms that we use here. Thank you.
Thanks, Elaine. Sam, to you.
Paul actually, I think it's Paul, gave me a really helpful distinction between performance obligations and compliance obligations in one of the focus groups, which is that performance obligations are what the organization has to provide to its customer externally. A grant could include a requirement to invest in the NPO's own systems and infrastructure. It could require investment in an IT system or a computer or something like that, but it's not necessarily an external deliverable in the sense of a performance obligation. So that's, I think, one of the reasons for the words. The other thing that came up through CHAM was the imbalance between the legally binding and equivalent means. So a donor may have legal recourse that an NPO may not in practice. So an NPO may be under an obligation and have to recognize obligation, but the donor might, but it might not necessarily have the confidence to recognize assets that it's entitled to. So practically, if the donor says, well, sorry, I know we signed this contract, but actually we don't have the money, we're not going to give it to you, the legal recourse for an NPO to sue a donor to get that money that's entitled to just isn't realistic. And the other aspect to it was another equivalent means might be blacklisting by a donor. So if you don't deliver on your compliance obligations, they might not sue you, but they could blacklist you, and the consequences could be really extreme. They can also just not send the next tranche of money. So quite often it will be achieve this and then we'll spend this and we'll send you the next tranche of money. So those were all sort of real world situations that I thought were really important, especially this imbalance between enforceability between the different parties and the accounting implications of that.
Thanks, Sam. That's helpful. And probably, maybe if we go to Bill next, and then this might be the point to go back.
Excuse me, just very quickly, following up on what Sam said, she's making a distinction. I'm sorry. Sam was making a distinction between performance and compliance obligations, but neither one of those uses section 2 of section 23. There it's a promise. So what's the difference between, okay, performance obligation, I understand what you said. Compliance, I understand about the external. And then why the change to promise in part 2? That was never clear to me.
That might, I don't know if Karen or Paul wants to pick that specific up. I think some of this is consistency actually as we've evolved in terms of our thinking. So that might be that we need to actually pick that one up, Bill.
Yeah, if I
go. Yeah, if you want to go, Paul, yeah.
I think it's just why we've used promise in part 2 is that's the wording in IFRS for SMEs. They talk about, and I think it's the wording in IFRS 15 as well. They talk about the promises that the entity makes in its contract. So the entity in the contract will include a number of promises by the entity as to what it's going to provide. Yes, those promises are performance obligations,
Okay.
And performance obligations are the words, is the word used in, I think it's section, is it section 24?
Yeah,
I
that
think
may
it's-
very
yeah,
well be that in the,
yeah.
for SMEs, yes, but in IFRS 15, I don't think they use promise, they use performance obligation. But be that as it may,
Mm.
that's why you did it. Okay.
Yeah, we just haven't changed the wording in Ipsas. Sorry,
Okay.
in part 2, we've tried to keep as close as possible to the IFRS for SMEs wording.
And I'm not even sure I'm not even recommending you change it. I was just curious after Sam's explanation what the distinction might have been, but it's not, you're making a distinction, you're being consistent. Okay, thank you.
Yeah.
Okay. Thanks,
Yeah,
Phil.
and Sam's right that the way the compliance obligations are wider than the performance obligations in IFRS 15 is that they do include those obligations that do not involve a transfer of goods or services to either back to the purchaser or to third parties. IFRS 15's explicit that performance obligations relate to transfer of goods or services, typically back to the customer.
Thanks, Paul. Did you just want to walk through those examples? Yeah, I mean, I don't think we're not going to conclude the debate today, but I think it's useful to actually get the feedback to the examples that are there, because again, it starts to draw this out.
Yeah, so if I take the first two together, which are just grants for general operations, nothing specific whatsoever, but for different periods, we don't think that they would meet the they would be presented as with restrictions because you can't identify specific expenses that would relate to them. They're not, they can be used for any purposes. In terms of recognition, it would be when you control the resources. In the case of a 3-year grant, that might be when you enter into the grant arrangement, or you may say, well, actually, maybe if you get the grant for years, the 3 years up front, you would potentially recognize all 3 years up front. If you get the grant by each year, then you would typically recognize year 2 and year 3 when you receive those particular resources. But there's no compliance obligations in either of them because they are for general purposes. Those, I think, are relatively straightforward. The next one is one that has been raised at various meetings. I think TAG and PAG have probably both mentioned this. So this is where you have online campaigns for a particular purpose, for a particular cause. These we think should be presented as with restrictions because you've raised the funding for a particular purpose. You could identify expenses that are relating to that purpose. And in some jurisdictions, there may be a legal requirement to use those funds for that purpose as well. But there are no compliance obligations. There's nothing, because there's no binding grant arrangements, there's no rights that the donors could enforce. So you would be recognizing revenue once you control the resources. Again, no compliance obligations. That, I think, is probably reasonably straightforward as well. The next one, I think, is where we start to get into the more complex issues. So you have an enforceable grant for research into malaria. Would you present that with restrictions? I think the answer is yes, because the grant is limited into that research. When would you recognize that? I think that would very much depend on the terms of the grant and the nature of the organization. If the grant is for a specific research project, then you would probably say, well, there are compliance obligations, and you would recognize the grant as you satisfy those compliance obligations. If the grant is for research into malaria more generally, and the NPO is carrying out a number of different projects on that, and therefore could direct the funds to whichever project it wants to, change its mind, move things around, then arguably it's that the terms are not sufficiently specific to give you a compliance obligation, because you could change your mind about how you use it. There's nothing, measuring it would be, you couldn't really measure your performance because you've got total freedom as to how you use the funds within that area of malaria research. So for that, I think, talking about between myself, Karen, Phil earlier, we thought if you've got that range of projects that you could allocate it to, and you can keep changing your mind, shifting it around depending on how circumstances change, there probably isn't going to be a compliance obligation. So you'll be recognizing revenue on control of the resources, but it's still restricted because you still couldn't spend it on research on other areas. And then I think the next two are again sort of more clear. You've got a grant to purchase an asset. Yes, that would be restricted. There would be compliance obligations. It's linked to the purchase of the asset. So you would recognize revenue on satisfaction of the compliance obligation. Grants to deliver agreed programs for a defined group, defined time frame. And then again, very clear what is required. So you would treat that as restricted and recognize revenue on satisfaction of the compliance obligation. So I think at it's a spectrum. At each end of the spectrum, it's relatively clear. In the middle of the spectrum, it's much more about judgment and individual circumstances and having to use professional judgment to come to a conclusion. But I think we think there will be cases where you don't have a compliance obligation, so you're not in the binding grant arrangement situation, but where nevertheless the revenue that you receive would still be restricted. So I think that's what we were trying to get at with the funding arrangement limitation definitions. We don't think we've nailed that with the definitions as they were in the paper, so we would definitely need to revisit. But I think we're also looking at how we whether we actually can amend the drafting to be easier and actually avoid having to have additional definitions. Karen's been suggesting, and I think from the discussions we've had, it makes sense. We think, given how important fund accounting is, given how central it is, and given how much it interacts with lots of different sections, a separate section that covers the funding accounting arrangements would actually allow all of these things to be brought together into one section and avoid a lot of additional complexity throughout INPAG. So Karen, you may want to say something about that, but I think we feel that if we could sort of develop that section on how you do fund accounting, we could probably just include cross references back to that section and avoid the need for additional definitions.
Thanks, Paul. There's a lot to cover there, but I think that in terms of the various different debates, and clearly it's moved on since the papers were issued, but probably that last point is actually, that's at the core of it, that we actually do need to specifically provide guidance on fund accounting. Because I think when you look at that, as Paul has correctly identified, it's those two examples in the middle where you say, well, actually, are restrictions and compliance obligations the same? Yes or no? But if they're not, what is it that differentiates them? Because it comes down to enforceability, and actually, is there a right of return? Because if there isn't a right of return through legal or equivalent means, then actually, is it restricting? So it's quite complex, this. And I think that's probably where we do need to draw that out, because the fund accounting point is the MPO specific issue here, really. So I just, if there's any last comments anybody wants to make, just mindful of time, that's I think the proposed way forward, but just open for comments. So Catherine.
Yeah, I guess firstly, I just wanted to commend the work done here, because I think we're getting to a really good place. I think from where the last draft was to what was in the paper is becoming a lot more clear to me. I mean, I think, Paul, to your point, there's a spectrum, and the challenge is always going to be where things fall on that spectrum. But sort of this categorization is helpful to me. The one thing I just wanted to highlight was kind of around the time-based ones. And I guess it's the second example on the slide that we're looking here. I have a bit of discomfort with some of the conclusions here, particularly around and you know, I don't know if this is necessarily a common scenario, but if a grant is received and technically not supposed to be spent for a couple of years, recognizing that immediately can overstate the performance of the entity, and particularly in close calls may suggest that the organization is more more of a going concern than it may actually be. So I think we just need to be very careful about that and link it back. Like if we're going to reach that conclusion, then I think what we're essentially saying is that time-based requirements wouldn't be limitations, and so we would have to link back to the definition there. So I think that one just needs a little bit more thinking.
Thanks, Catherine. Yes, time is always problematic. Anthony.
Thank you. Yeah, there's these middle examples. Looking at the online campaign, I agree it's not a compliance obligation, but I'm wondering where the concept of a constructive obligation fits in, because you've got to spend the money on the cause that you've advertised.
Yeah, and I think, as we mentioned elsewhere in the paper, where we think there may be those sort of constructive obligations, the plan is to refer users to this, or MPOs to the section on provisions, etc. And so that we say, recognize it, consider if there is a liability by reference to the provisions section. So that would pick up your constructive obligations there.
Thanks, Paul. Again, though, the question is to think that in the context of actually that might be a provision for costs, but does that necessarily mean that the income is actually restricted? Tim.
Yeah, I wonder, did you consider it not often there's a budget agreed, right, with the donor, and there may or may not be an expectation that if you overspend the budget, you might have to so I was just wondering why that wasn't on the list, because that's a very common one, and it does seem that that's again an area of in the middle of your chart, because if the donor will accept if you like, you can't really, you don't have control of the resources until the donor has accepted your report against budget. Seems to be a very important factor.
I don't think the examples were intended to be exhaustive. Actually, they were sort of top of the head from the Secretariat over the last 24 hours or so to try and stimulate discussion. So I think that's where your example is also helpful. It just goes to show how tricky this actually is. And it's why it took IPSASB a long while to work its way through to what ended up as being called compliance obligations. And that was also, we were also trying to address there the points that Catherine made around where you have a sort of time requirement. What does that actually mean? And it basically comes down to, do you have a binding arrangement, was the view that the board got to. So I think it's those examples that challenge your thinking and need to be, so if you can pass that one through, Tim, I think that will be really helpful. It's actually just having a look at the fact patterns, which actually, certainly challenged us, and we did a lot of work with the UN organisations as well on grant patterns for them to try and work these things through. Okay, so I think we're at the end of the call now. I think I think it's helping us in terms of this is really the nexus that we have to work through is the interface with fund accounting. Karen, I think probably it's back to you really in terms of, clearly there's a scheduling issue here really, isn't there, in terms of, I think we've made good progress on the other areas. Clearly there is some interface then between revenue and the grant expenses, but back to you on the overall scheduling.
Yeah, so I think as Ian highlighted, that is the challenge for us now, and it's not just grant expenses, it's also foreign exchange as well, where there is commonality of concepts and language that need to go through. Our intention was to provide final drafts of all of ED2 for the June TAG meeting, because that essentially is the schedule that we need to get to, or not much beyond it, to hit a September publication date, which is what we're looking at now. We're looking at publication on the 27th of September. And so that TAG meeting would be the final meeting in terms of approving content to allow the publication process to go forward. What I need to take away and have a think about post this meeting is that's an incredibly small window now, given that we have not landed some of these points today. We've essentially got 4 to 5 weeks to enable us to redraft. And so that is going to be exceptionally challenging for us. So I'll have to go away and have a think about that. We would certainly benefit, I think, from further discussion of this. I know we can exchange emails, etc. But I might look to see if we can just get perhaps smaller groups of you that are a little bit more time friendly to have some conversations about, and we'll share the slides, but particularly those examples and the implications of those, and see if we can do those over the next week. I think if we're to try and attempt June, I think that would be the time frame that we would need to work to. So that's what we're looking at. We're still planning to have a face-to-face meeting in September in London, adjacent to World Standard Setters and IFAS. And the focus of that meeting would be on the drafting for ED3. I think, as we heard today, we're going to have some difficult things to work through in terms of the interplay between the supplementary statement, classification of expenses, and we also need to return to the topic of equity, which challenged us previously. We might get a sense of deja vu, but we need to cover that again. And I will be looking to put in a TAG meeting on December the 12th. And that will be the TAG meeting where I'll be looking to clear ED3 for publication, and we are looking at a publication of ED3 at the end of February 2024. So those are sort of at a high level the timeframes that we're working to. Incredibly challenging. You will have notes that we haven't given you any feedback on ED1. And that's because we're all heads down on ED2 at the moment, but we would hope for the September meeting that we want to do this in any case, to have the discussion on equity, is to provide some feedback on the ED1 responses at that point in time. So that's how I kind of see the next few meetings shaping up.
Thanks, Karen. So perhaps you can just drop those dates around to everybody when we come back on thinking on the way forward on revenue, so that we've all got that roadmap and the dates and diaries and all that. I think that Jenny, that was your point, wasn't it, in terms of, yeah, okay. Great, okay, well, thanks everyone. We've compressed a huge amount into 3 hours, and I think thanks very much to everybody who's provided comments. It's been, really amazing what you've actually done as a group for us. So thank you again for that. I think also thank you to the staff for synthesizing and focusing on the issues that we needed to. I think that's actually it's nailed a lot of things down. Even although we've still got this very tricky area that we're going to have to deal with in terms of how we take revenue forward. So I think we should focus on what we have done, it is huge, this, and we are approaching some of the really tricky issues but I think we're starting to draw them together, which is also, I think, really important. So, you know, thanks for those, if you like, those discussing comments which have come out today, which I think have been really important. So with that, I think we'll wrap up for today. And just again, thanks very much. Great to see you all. And, you know, I think we'll start to look forward to what we've got to do in September, when hopefully we can, as many of us as possible, can be together in person.
And can I ask, in terms of the September meeting, if you could let me know whether you intend to be there in person or not? That would be incredibly helpful, so that we can plan that meeting forward. I think Bill's just sent me a comment about the published roadmap that we have in terms of the dates for ED2, ED3. We will be looking to update those to reflect the changes that I've just described.
Great. Okay. Well, thanks now, everybody, and see you again in June, if not before.
Thanks very much, everyone.
Okay. Cheers.
Bye, everybody.
Bye.
Thank you.
Bye, everybody.
Thank you.